As a business grows, it's likely that it will need more money to support this growth and its competitiveness in the market. For example, businesses may need more money to develop new products, purchase new machinery and equipment, recruit more employees, or even to increase the size of their premises. When looking to source finance, businesses can do this either internally, which is also known as organically, or externally, which is also known as inorganically. Let's take a look at some of the common examples of internal and external sources of finance which growing and established businesses can utilise. Starting with internal sources of finance, which can include retained profits, selling assets, and the owner's savings. The term retained profits refers to the profits that the business has made in the previous years of trade. It's called retained profit because it's been kept or retained in the business for future investment, instead of it being paid out in dividends to the owners and the shareholders of the business. Retained profits have the advantage of being very quick to access, which is very convenient for the business, and there are no fees or interest to pay, as it's the business's money. But many businesses might find that they've only got a limited amount of retained profits, which might not be enough. And on the other hand, if too much profit is retained by the business, it's likely that shareholders will become frustrated due to the lack of dividend payments they're receiving. Moving on to the selling of assets, which is another key internal source of finance. Essentially, a business can sell any asset that it owns to raise finance, which can then be reinvested into the growth of the business, such as funding a future project, or even to purchase an improved version of the asset that they've just sold. For example, this could be a vehicle, machinery, or even equipment which the business owns. The great news is that selling assets provides a business with a cash injection, and is especially beneficial if the asset is no longer needed or wanted by the business. But if a business is selling an asset that they might need in the future, to raise finance in the short term, this can cause problems later down the line, such as a business having to pay more than what they sold the asset for to replace it in the future, or the business not being able to complete a certain task because they don't have the asset anymore. The final internal source of finance that we're going to discuss is the owner's savings, which is often referred to as owner's capital. In simple terms, this is the money invested into the business by the owner. It's very common for the owner of a business to invest their personal savings. This can be right from the start to fund the startup, or all the way through to fund expansion projects. The key benefit of utilising the owner's savings is it's a very quick source of finance to acquire, and it does not cost the business as there is no interest charges or fees applied. But not every business owner just has loads of money sitting around in the savings, so it's not always a viable option. So that's the internal sources of finance covered. Let's now move on to the external sources of finance, which include loan capital, share capital, and stock market flotation. Loan capital refers to the money that a business borrows from a bank or another financial institution. When a business sources finance via loan capital, they are given a lump sum of money which is expected to be repaid over a set period of time. This allows a business to make a clear judgment about the affordability of the monthly repayments and how the loan will impact its monthly cash flow before deciding whether to accept the loan. But loan capital can be an expensive source of finance due to the interest that's added on to the repayments, and a business might not even qualify for the amount that they need to borrow. In fact, in some cases, banks may actually ask for collateral for the loan, just in case the business doesn't pay it back on time, which decreases the risk of lending for the bank. For example, a loan may be secured against the asset that the business is actually borrowing the money for, and if the business fails to repay the loan, the bank can seize the asset. In contrast to loan capital, share capital is when finance is raised by selling a percentage of the business by offering shares to potential investors. The benefit of raising finance through share capital is that the business doesn't have to repay any of the money, nor is it charged any interest or additional fees. Also, the business is in complete control over who it offers shares to and can turn down offers from anyone it doesn't want involved in the business. But only limited companies can source finance through share capital. And once a business receives money from selling shares, control of the business gets diluted, as these new shareholders are now due a share of the business's future profits, which are often paid in dividends. As a limited company grows, it can also source finance via stock market flotation by becoming a public limited company and offering shares to the general public via a stock exchange. This can provide a business with the opportunity to raise large amounts of money, and the best thing about it is they don't have to repay any of it and they're not charged any additional fees or interest. But this is one of the most complicated sources of finance, and over time, the owner risks losing complete control of the business as anybody can buy shares.